This is Horizon's Middle East and Africa, our top stories this morning. Stocks rally in Asia and Treasury yields fall for a second day as traders reassess bets on Fed rate cuts and risks from the U.S. election. Israel and Hamas negotiators will meet in the coming days in a renewed effort to end the war in Gaza. Plus, Africa's financial markets are expanding at the fastest pace in 7 years, the main drivers being a recovery in economic growth and slowing inflation. We have all of that for you this hour. It is just gone 8 a.m. across the Emirates, 6 a.m. in South Africa. I'm Jennifer Zabasaja in Johannesburg, in this week for Jumana Bersachi. Well, it is Friday. We made it, and it feels like stocks, the market's potentially saying something similar. If we take a look at where futures are positioned right now, ever so slightly down, unchanged if we take a look at U.S. equity futures in particular. But don't be fooled, because Thursday was not a day to put aside. We saw stocks fluctuating throughout the day as we continued to get earnings from a number of the biggest companies. And we did see U.S. equities ending the day largely in the green. And that was mainly due to Tesla. More on that in a minute. And I know you are seeing right now them a bit unchanged right now. Also, treasuries, we've been talking about this all week long. Right now, backing off from what has been quite a volatile week for the bond market. Right now, we're seeing the U.S. 10-year at 4.1879, and they're continuing that second day lower, of course, as traders reassess Fed rate cut bets. Also, Brent crude, we've been paying close attention to it, pushing higher right now, up just about 0.2%. Thursday, though, we did see crude take a hit as oversupply concerns creeped back into the market, and also traders continuing to assess what is happening in the Middle East. But I want to take you back to U.S. equities, because Thursday was a massive day for Tesla. And this chart is going to tell you just why. Tesla has had a blowout few days since they reported earnings earlier in the week. And on Thursday, the company had its best session since March of 2021. Just take a look at that, adding a market cap of more than $156 billion, also making Elon Musk there a bit richer. But that is the electric rally that Tesla has had. Let's pivot, though, to markets in Asia and see how they're faring. Avril Hong is standing by in our Singapore studio. Hey, Avril.
Hey, Jen. Yeah, we're seeing Asia's major benchmarks mostly tracking Wall Street. The outlier today is Japan as we head into an election weekend where polls show that the ruling coalition could lose its majority. The concerns about policy implementation weighing on equities, though we are seeing a bit of flatness on the yen after the gains from a day ago. I did want to highlight this next chart. If we can flip the board and take a look at what we're seeing in terms of big picture, the topics has been underperforming developed markets overall. And I think this speaks to the risk going ahead into election weekend. But this is also a dynamic, as our MLife strategist Mark Cranfield has been highlighting, the weakness on the Japanese currency coming in potentially, because if there is some slower policy implementation from the government, that might cause the BOJ to maybe think twice about its rate hikes. That could be helpful for Japanese equities. So this is a dynamic that we're watching closely as well as we keep an eye on stocks. Jen?
Thanks so much, Avril Hong in Singapore for us. We'll see you in just a bit. Let's pivot, though, to the IMF. Bank of Israel Governor Amir Yaron says the Israeli economy is showing resiliency in the face of the ongoing war, which the central bank expects to continue into the first quarter of next year. Speaking with Bloomberg's Lisa Abramovitz in Washington, Yaron says given the scope of events, there is still a lot of confidence in a relatively stable shekel.
The war has gone longer than initially anticipated. Right now, our basic forecast and scenario is that the war will continue roughly until into the first quarter of 2025, with an intensity sort of like what we're seeing now for another month or so, and then slowly take a notch down. Now, the critical parameters when you do this, and that's what we've learned, is what is the intensity of fighting and the number of reserves? Is the educational system open or not? We saw that was critical at the first month in October when missiles were flying around. We see a little bit of that in the north part right now. and obviously areas where there's limited activity. Those are key parameters for growth. There's I gave you kind of the basic scenario. Of course, there are alternative scenarios where the war goes on for longer. There are alternative scenarios where there may be even more intense.
Well, how hard is it to attract foreign investment at a time when there is this range of outcomes that's very wide?
I would say one thing, given clearly this war is of different scope in terms of duration and its scope, and yet when you look at the Israeli economy, it is showing a lot of resiliency. First of all, our external position is extremely sound. Our current account is still growing. We are seeing the shekel being volatile between 3.6 and 3.8, primarily due to geopolitical events, but still given the scope of events, it is very. I would say it's. Some people would have thought maybe it would be moving even more, and so that shows a lot of confidence. I would say people are buying houses. That is the most illiquid asset you could think of, and Israelis are buying houses. House prices have come back to go up. So those we're seeing exports. The high-tech sector, for example. We are seeing in Q2 and Q3, some of the VC funding has gone up. The services, export services of the high-tech sector have in fact been coming up.
Bank of Israel Governor Amir Yaron there. Let's stick with the Middle East. Negotiators between Israel and Hamas will meet in the coming days as they make a renewed effort to end the conflict in Gaza. U.S. Secretary of State Antony Blinken is in London to meet Arab foreign leaders later today as the U.S. explores different options to reach a ceasefire. Let's get to Bloomberg's executive editor for Middle East, North Africa and Russia, Stuart Livingston Wallace. So, Stuart, we heard there potentially there's an expectation that the war will continue into Q1. But, you know, if we are potentially to see negotiations happening right now, what's the likelihood it'll actually yield some resolution?
I mean, in the short term, it seems incredibly unlikely they're going to be making any headway. And you've got a few fundamental problems here. No one, as far as I'm aware, within those negotiating parties even has a basic text to work off. Let's go back to an even more basic problem is who exactly is in charge of Hamas and what exactly is the Israeli appetite to get some sort of resolution at this particular moment. So, yes, I think it's a continuation of the guarded optimism that you've seen from the international community and this very sincere, clear desire to reach some sort of settlement. But if the two main negotiating parties, that is the Israelis and Hamas, are fundamentally opposed on their objectives and the way they see the peace unfolding, it's very hard to see how you could get anything done in the short term. Add to that the impending retaliation that we're expecting by Israel on Iran for those missile attacks we saw several weeks ago. Again, that just adds to an incredibly volatile mix. It's very hard to see how you can end up with the ceasefire.
Absolutely, Stuart. And add to that, the U.S. election coming just a few days away. We also got this news, Stuart, about potentially this audit of Israel's use of U.S. weapons that the Pentagon is going to look into. I mean, does this potentially put the relationship between the U.S. and Israel in jeopardy and complicate it leading into the election?
I mean, I guess we'll see what comes out of that. But if we look at precedent, you know, there was a very brief moment where they delayed shipments to Israel. I think there was probably only one occasion on which that happened, and then that was reversed very quickly. Because, again, the fundamental position here is that the U.S. will back Israel. So it will make noises, it will try and guide Israel in terms of its actions on the ground, in terms of humanitarian aid, particularly into Gaza. But when it comes down to it, the U.S. is a very solid backer of Israel, and I don't see that changing regardless of the outcome of the election.
All right, we'll leave it there. Bloomberg's Stuart Livingston Wallace joining us in our Dubai studio. Stuart, thanks so much for joining us. Now, still to come, RBC Wealth Management thinks the Fed does not need to cut rates next month, but might do so anyway. We'll find out why next. This is Bloomberg.
U.S. economy is one of the strongest among the major economies, if you look at those. And when we compare the U.S. to the other G20 economies, it's the only economy whose GDP is higher now than we had projected before the pandemic. The only major economy. So it's a very strong economy, a lot of confidence in it.
That was Geeta Gopinath, IMF First Deputy Managing Director, talking about the U.S. economic strength. And as we take a look at Treasuries right there, Treasuries fell for a second day as traders reassessed bets on U.S. rate cuts as more data gave clues on the health of the U.S. economy. Let's bring in Frederique Carrier, Head of Investment Strategy at RBC Wealth Management, who's joining us now from London. Frederique, great to have you. So Geeta there talking about the strength of the U.S. economy, but there are risks abound, right? I mean, how are you positioning then at this point in time, considering the confluence of factors that you need to be thinking about?
Good morning. Look, we agree clearly that the U.S. economy has proven to be very resilient. It's very healthy at the moment, as it is, it does not really warrant much more monetary stimulus. But we do think that at the November meeting, the Fed will probably opt to decrease interest rates by 25 basis points, if only not to suggest that the 50 basis points cut earlier was a mistake. So we do expect a little bit more stimulus. And after that, it will very much depend on labor markets and inflation continuing to behave. We're spending a lot of time clearly preparing for the U.S. elections. For us, that is, and for markets, it's a clearing event. And markets at the moment seem to be discounting very much a Trump victory. If that materializes, we would expect the stock market to build on current gains, and there is a risk that there might be an overshoot. If there is a Trump presidency, we would expect tariff negotiations to be very acrimonious if the previous playbook is anything to go by. So we would pair some of the positions of the countries which are in the crosshairs and perhaps build positions in treasuries. 4.4% on the 10-year is an attractive entry point in our view.
When it comes to equities, Frederique, we were mentioning Tesla, surging on Thursday, the Magnificent Seven really having a significant rally over the past few months. I mean, are there other equity opportunities that you're seeing to add to your portfolio?
So we're looking at a potential rotation movement out of the very high growth stocks and into other parts of the stock market. If you look at the earnings upgrades, it's really other sectors which have benefited for 2024. It's the financial sector which has been upgraded the most in terms of earnings. And for 2025, it's healthcare, industrial materials. So we would not neglect these parts of the market. Certainly healthcare for 2025 has the highest growth expected. The Mag 7 growth rate is waning on a comparative basis, and other parts of the sector of the market seem to be being upgraded. So we think that will fuel some interest in those.
What about other parts of the world, Frederique? I mean, people talk about U.S. exceptionalism. But are there other opportunities that are getting left on the table as the focus is on the Mag 7?
So we think that Japan is an interesting opportunity, and it's certainly our major overweight in terms of countries. We think that the Bank of Japan is very conscious that the economy does not grow very quickly, and so it will increase interest rates very cautiously. You have a market where corporate pricing power has returned. Wage growth is now more entrenched. Valuation levels are attractive. So these concerns about the upcoming election could provide an additional interesting entry point into this market.
Does the election, though, this weekend potentially upend that, Frederique?
So we don't think that, while we acknowledge that markets are very concerned, we don't think that there would be major changes in monetary policy, certainly, and in macroeconomic policy. The return of inflation is a welcome one, and therefore that is why we continue to maintain this position.
Great to have you on and get your insights this morning. Frederique, Head of Investment Strategy at RBC Wealth Management, joining us from London this morning. Great to have you. Now, coming up, the U.S. versus Europe. UBS CEO Sergio Ermotti discusses the banking landscape and consolidation. More from that interview next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. UBS CEO Sergio Ermotti warns fragmented banking regulation in Europe is leading to higher borrowing costs and lower shareholder returns. He told Bloomberg's Lisa Abramowitz why he thinks the economy may ultimately end up paying the price for not allowing the free movement of capital between European countries.
At the end of the day, the cost is paid by the economy, by clients. I think, of course, shareholders are suffering, but eventually cost of borrowing and the facility and the easiness of accessing credit is impaired. So allowing capital to freely move across jurisdictions creates less cost for the economy.
Is there a warning from the Credit Suisse saga? You've benefited from it on the other side. Your assets have increased. You've delivered earnings that outperformed expectations. There is a sense that banks that seem okay are suddenly not okay in a very fast money world. Do you worry that that's the case elsewhere?
No, I don't worry, because if you look at the Credit Suisse situation, it was a very idiosyncratic topic that developed over the years. The business model was not sustainable. They didn't really have a great governance, and they benefited for too long from a regulatory concession that should not have been granted, or at least not for so long. And that was a quite unique situation. If you look at what happened back in March 2023, banks, large banks, were actually safe haven, were part of the solution, in a sense, in the US, but also with UBS in Europe. So big banks were solid, and it showed that well-designed regulators can avoid the repeat of the financial crisis. But if you go too far, then you create costs, not only for shareholders, again, also for clients. When is going to cost more to borrow, is going to slow down investments, and so that's not the ideal situation. There's a saying, and it's not mine, so you can't blame me or credit me, but that the United States innovates and that Europe regulates, and that seems to be the way and the path of travel, and it's the reason why a lot of people expect the U.S. to grow really significantly and less so in Europe. How much do you see that bifurcation continue with investor flows? Don't worry, I'm not going to disagree on that. So, okay. It's quite clear. You saw it in the last 20 years. Numbers talks clearly, and the underlying trend seems to go still in the same direction. There is a desire in Europe to change path. You saw with the Draghi report, with a lot of very comprehensive report analyzing the state of Europe, with a lot of ideas that, unfortunately, are going to be quite difficult to implement. The reason is that you need 27 countries with quite different interests to agree on a common goal that may result in some of them losing short term for the benefits of the long-term benefit. And in this environment, it's very difficult to get voters to support any sacrifice. And so it's likely that you're going to continue to see the U.S. outperforming Europe.
UBS CEO Sergio Ermotti speaking with surveillance anchor Lisa Abramowitz. Now, here's a look at some other stories we are following this morning. Morgan Stanley says CEO Ted Pick will become chairman of the board in January. He's replacing his predecessor, James Gorman, who said in May that he would step down by the end of the year. Gorman will take on the title of chair emeritus after leaving the board. A McDonald's supplier is recalling some yellow onion batches produced in Colorado in response to a deadly E. coli outbreak at the burger chain. Taylor Farms, which supplied onions to restaurants affected by the health investigation, says it hasn't found traces of the bacteria yet, but is pulling the products out of caution. Major food distributors affected by the recall are also contacting their customers. TSMC says it has achieved early production yields at its first plant in Arizona that surpassed similar factories in Taiwan. The company says the share of usable chips manufactured at its facility in Phoenix is about 4 percentage points higher than comparable facilities in Taiwan. The accomplishment is a sign of progress for Washington's efforts to revitalize American chip manufacturing. And it has been 43 years since Major League Baseball's most high-profile teams, the Yankees and Dodgers, have faced off in the World Series. And the decades of the pent-up demand in Los Angeles and New York has sent ticket prices soaring to record highs. Average prices hit $1,700 with tickets for Game 3 at Yankee Stadium, set to be the most expensive in World Series history, with an average price of nearly $2,000. And for those wanting to sit behind home plate or even above the Yankees dugout, well, that will cost you more than $20,000, according to ticket listings on StubHub. And finally, the U.S. Department of Justice has settled with Grace Ocean and Synergy Marine, the owners and operators of the Singapore-flagged ship that struck and collapsed the Francis Scott Key Bridge in Baltimore earlier this year. The vessel owners settled for about $102 million to resolve the civil claim. The settlement does not include any damages for rebuilding the bridge. Now, Bloomberg recently launched the weekend edition, going deeper into the context of stories that shape markets and the world. You can scan the QR code there on your screen to subscribe to the newsletter, which contains essays, reviews, and other stories that take an expansive view of finance, the economy, life, and culture. Definitely take a look at that. Now, coming up, Africa's financial markets are expanding at the fastest pace in 7 years. That's according to Absa. We'll bring you the details next. This is Bloomberg. This is Horizons Middle East and Africa, our top stories this morning. Stocks rally in Asia and Treasury yields fall for a second day as traders reassess bets on Fed rate cuts and risks from the U.S. election. Israel and Hamas negotiators will meet in the coming days in a renewed effort to end the war in Gaza. Plus, Africa's financial markets are expanding at the fastest pace in 7 years, the main drivers being a recovery in economic growth and slowing inflation. It is just gone 8:30 a.m. across the Emirates, 6:30 a.m. in South Africa. I'm Jennifer Zapasaja in Johannesburg in this week for Jumana Bersechi. Happy Friday to you. Markets also potentially breathing a sigh of relief that it is Friday. Let's take a look at where they are at this point in time. U.S. equity futures relatively stable, unchanged, but don't be fooled because Thursday the markets had a day. We saw stocks fluctuating quite a bit throughout the day as we continued to get some earnings from some of the biggest companies. Ending the day, though, U.S. equities in the green. That's largely due to Tesla. We'll have more on that in just a few minutes. If we take a look at the 10-year, Treasuries has been the big story all throughout the week. Right now, Treasuries backing off from what has been quite a volatile week across the world. But the U.S. 10-year right now at 4.1879, continuing their second day lower as traders, as we mentioned earlier, reassess those Fed rate cut bets. And Brent crude right now pushing higher after a 2-day drop right now. Brent crude up just about 0.2% to $74.53 a barrel. Thursday, though, we did see crude take a bit of a hit as oversupply concerns creeped back into the market. And again, that coupled with what we're seeing in the Middle East potentially having an impact on supply and demand there. But I want to take you back to Tesla because Tesla has had quite a big week. Elon Musk has had quite a big week. And this chart really sums it up. Tesla had those blowout earnings just a few days ago. And the company on Thursday had its best session since March of 2021, adding a market cap of more than $153 billion, making Elon Musk much richer, but definitely significantly pulling up U.S. equities as a result. Now let's check in on how markets in Asia are faring right now. Avril Hong is standing by in our Singapore studio. Hey, Avril.
Hey, Jen. Yeah, thanks to Tesla, we're seeing most of the benchmarks in the region gaining ground, tracking Wall Street. But no such luck in Japan because we are headed into election weekend. And as I talked about earlier on the program, polls suggest that the ruling coalition could lose its majority. It's not just about Japanese politics, it's also about monetary policy. And going into next week is when we're going to get the BOJ decision. No move expected this time around, but we're going to be watching very closely for signals whether this influences the December and January potential rate hike timing. Now, against that backdrop, we're seeing a bit of the yen gains from a day ago continuing, extending a bit of ground. But I wanted to highlight what we're seeing in terms of implied volatility on dollar yen, because if you take a look at the 2-week timeline, that shows you that the Fed as well as the U.S. election, that is also a concern for traders, perhaps more so than what we're seeing domestically in Japan, Jen.
Avril Hong in Singapore for us. Avril, thanks as always for joining us. Now let's turn to Africa, where despite a positive upturn in the economy, social and political factors are stalling growth for the region and creating a challenging path forward for policymakers to build onto their reforms. I spoke with IMF Deputy Director for the African Department, Cathy Pattillo. Here's what she told us.
We're seeing overall macro imbalances declining. Inflation is down. Fiscal balances stabilizing. Public debt, which had been rising for almost a decade, also stabilizing. And the external reserves also improved. But in working toward these reforms, policymakers are faced by some really challenging conditions. First, growth remains still subdued and uneven. Second, the domestic and external financing conditions are still very difficult. The cost and availability of finance is not enough. And third, the social and political context for reforms is challenging.
Let's pick maybe each of those apart, Cathy, and just start with the social and political part, because I noticed in the report that phrase came up quite a bit throughout the report. I mean, what impact has that really had on growth for the region?
So the complex interplay that countries face of high levels of poverty, lack of inclusion, perceptions sometimes of weak governance and corruption, and then what populations have faced over the recent years of incredible shocks, which have led to, cost of living crisis with high food prices. This means that it's again, very challenging for authorities, and they really need to pay attention then to building social consensus and building buy-in for reforms. They need to make sure that as they move forward, the vulnerable are protected, building and maintaining and accelerating social safety nets, and that the agenda, which is a reform agenda, builds jobs for the population, the growing populations.
IMF's African Department Director, Cathy Pattillo, speaking with us just a little earlier. Let's stick in the region. Africa's financial markets are expanding at the fastest pace in 7 years. That's according to the latest Absa Africa survey, which shows the continent is benefiting from a recovery in economic growth and slowing inflation. For more on this, let's bring in Bloomberg's Adelaide Chengole, who is joining me now in studio. So Adelaide, you cover the banking sector for us here. I mean, what were the main takeaways for you on this report?
So Africa is benefiting because economic conditions throughout the globe are improving, and a rising tide lifts all boats. So we've seen GDP growth expanding, we've seen inflation cooling, we've seen currencies are stabilizing in the continent, which is helping the debt metrics are looking a little better. We've seen African markets having introduced a lot of new products. So this report basically looks at how African markets are performing based on their accessibility, their openness, their transparency. And based on that, 29 countries were surveyed in the report, and of their rankings went up 82%, which was the fastest pace since the report started being published in 2017, which was really significant.
But we're still seeing, as this full screen is showing, I mean, Rwanda was the highest riser. When we look at the top markets that are the top 5, are we still seeing the same few that are rising to the top, or are there other trends that are maybe creeping in?
Yeah, so the top 5 did not change for a second year. South Africa remained at the top just by virtue of its big financial markets. And even though the economy, in South Africa is not growing as fast, the fact that it has such a sophisticated, deep market has made it, an outstander. So it was number 1. And then we had Mauritius, Nigeria, Uganda, and Namibia coming up as a top 5. And then we had Egypt coming in at number 11. It had dropped in ranking slightly, but it still retained its position at number 11 just by virtue of some of the challenges that it's had recently. And then last place was Ethiopia, which was ranked 29th, just by virtue of the fact that its economy is not their capital markets are not so sophisticated. But I must say the report did cite some of the reforms that are going on there, things like liberalizing of its FX market. They're also doing a really big IPO this year. So maybe next year the ratings for Ethiopia might be a little different. But for this year, they were number 29.
So a little bit struggling. And we talked to Cathy about some of the funding squeezes that a lot of these countries are going through. When it comes to debt, Adelaide, this is still a concern, despite what we're seeing in the macro picture. I mean, what does Absa point to? Why is this still such a concern for them?
Despite, like I've mentioned, the economy is looking better and the metrics are looking a little better, but still the metrics, just the overhang of the debt splurge that African countries went on is still kind of, lingering and is evident in the report. So the report cites data from the IMF, which says that 18 of the 29 countries that they surveyed are still at risk of high debt distress. So which means it's still quite a bit of concern with African countries. And even though, 4 of the African countries have been able to tap the Eurobond market, which is something that they have cited as a positive, there's still a lot of concern about, Africa's, the ability to service this debt and pay it off and kind of be able to get out in good standing.
Yeah, it's a fascinating report. We're going to leave it there, though. Bloomberg's banking reporter, Adelaide Changole. Adelaide, thanks so much for being here. Now let's stick in the region and bring you Mozambique. And Mozambique's ruling party candidate has been declared the runaway winner of the nation's presidential elections. Daniel Chapo won nearly 71% of the vote after a campaign tainted by claims of fraud, vote rigging, and the killing of opposition supporters, prompting protests across the country. The victory signals political continuity for Mozambique as Total Energies prepares to resume its $20 billion gas project. And for more stories like this from the continent, be sure to subscribe to the Next Africa newsletter on the terminal and on our website. And of course, our podcast available on Apple, Spotify, and wherever you usually get your podcasts. Now, coming up, Kenya's worst political upheaval in years hasn't taken the shine off its top-performing currency. We'll discuss what it means for the country's expanding economy next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Despite Kenya's political turmoil, global investors are looking past the upheaval to boost the country's asset bets. This as Kenya's central bank governor says policymakers are prepared to use record foreign reserves to defend the shilling. Bloomberg's Ndiro Oganga is joining us now from Kigali. So, Ndiro, what's the latest on Kenya's economy following those political developments that we saw just a few months ago?
Jen, one can say that Kenya's economic outlook is even beginning to improve. If you look at a couple of indicators, first beginning with the shilling, it's still the best currency in the world after it hit record low in January. It has rebounded by 27%, currently trading at about 128. And a couple of things can be attributed to this phenomenal run by the shilling. One, Kenya was successfully able to roll over its Eurobond. And two, they're expecting a disbursement from the IMF from the $3.9 billion program. And this has gone ahead to elevate the fiscal pessimism that we were seeing in the market following the government being forced to shelve the finance bill after protests. The central bank also very bullish, saying that they have enough reserves to buffer the shilling if need be. They're expecting international gross reserves to hit about 8.9 billion by the end of this year. And whatever direction fundamentals steer the shilling, they're willing to manage it a little bit smoothly. If we also look at bonds, they were a little bit rattled during the anti-tax protests, and we saw yields on 10-year securities rising to a 9-month high of 11.44% early August, but it has then cooled down by 1.75%. If you also look at our Eurobond, they gave investors return of 10%, 4 times what the average is in emerging markets. There are also other positive indicators. Inflation is moderating. The central bank began the cutting of rates in August, and also we are seeing that the economy grew by 5% in the first quarter. So irrespective of everything going on politically, the economy is proving resilient.
Indira, let's just stick, though, on the political factors, because there has been a lot of attention paid to what is happening politically. And in particular, we saw that impeaching of the deputy president. How is this playing out for us?
Jen, the perfect way to describe this is there are decades where nothing happened, and then there are weeks where decades happen. It's been event after event. First, the deputy president was impeached in the National Assembly and the Senate, and immediately he was impeached, the president, William Ruto, forwarded the name of the Interior Cabinet Secretary as the new nominee, and he was approved in Parliament because the ruling party has the majority. Barely an hour after he was approved in Parliament, the High Court issued an order, first of all, halting the impeachment process of the deputy president, and also the process of replacing him. So the new and proposed deputy president cannot be sworn into office. We're expecting a decision from the High Court today. But in whatever way they rule, this impeachment could turn out to be a good thing, according to economists, because on the grounds of which the deputy president was impeached, it will look as if Kenya is beginning to crack down on corruption and abuse of power, which is really good for investor sentiment.
Fascinating at what's playing out there. Bloomberg's Indira Oganga bringing us the latest. Thanks so much, Indira, for joining us. Now let's stick in the region. South African Reserve Bank Governor Lesetja Kganyago said the nation's inflation target was overdue for review and it should be adjusted lower. He spoke to Bloomberg's Lisa Abramowitz on the sidelines of the IMF and World Bank meetings in Washington. Take a listen.
I think that what we are clear is that we put our inflation target in 2000. It is now 24 years since we had the inflation target, and we had to ask questions about how optimal the current inflation target is. And it is the work that we are doing with the Treasury to then. What is clear is that if we revise the target can only be revised lower.
Do you think that in some way the emerging world and the developed one are converging? That in some ways you might lower your inflation target to 3%, and maybe it might be appropriate for a number of developed market economies to raise their inflation rate to closer to 3%. Could you see a regime like that?
Well, it has not been our baseline. I think that the emerging markets have come closer and closer to the developed market targets. I think what's clear is that there's no virtue in high inflation, and the lesson from the great inflation surge in 2022 had been that the public actually hate inflation, and actually the public will prefer price stability.
But what's the cost of having a lower inflation target? And this is something that the Federal Reserve is grappling with at the same time that they're talking about the dual mandate. They don't want people to lose their jobs in some sort of entrenched fashion, even if it means the consequence of having higher inflation. Do you think it's worth having a little bit more pain economically in order to bring inflation back into a closer to 3% range?
Well, the problem with that analysis, Lisa, is an assumption that there is no cost to the economy of having higher inflation. There is a cost. And we have seen it with the public rising against the high cost of living, and it is important that one is alive to that. That said, many central banks will then grapple with what we call the sacrifice ratio. How much growth do we have to give up in order for us to bring down inflation? What is clear is that once you have brought down inflation and the inflation rate is almost taken out of the decision-making matrix of the decision makers, price setters, and investors, then you know that you have brought in price stability.
That was South African Reserve Bank Governor Lesetja Kganyago speaking with Lisa Abramowitz. Now, coming up, Saudi is facing a pivotal moment just days before its flagship investment conference kicks off. We are live in Riyadh next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Johannesburg. Now, days before Saudi Arabia's flagship investment conference begins, the kingdom is facing a pivotal moment in its vision for the future. The first project at the mega development known as NEOM will open its doors to an exclusive group of VIPs. A hand-picked selection of guests is set to get a first glimpse of Sindala Island, a travel destination featuring ultra-luxury hotels on beaches in the Red Sea. For more on this, let's bring in our Saudi Bureau Chief, Christine Burke, who is joining us from Riyadh. So, Christine, just talk to us more about this exclusive party and what you and the team has found out about where NEOM is at right now.
Well, let's first get a little background on NEOM, because NEOM is Saudi Crown Prince Mohammed bin Salman's crown jewel project in the Vision 2030 agenda to diversify the economy away from oil. This is a development that's expected to cost up to $1.5 trillion. And truly, this is massive. This is basically designed to be everything from a tourist destination to a hub for clean energy, to AI, to a future of smart cities. And NEOM encompasses about a dozen different projects. And some of these things, honestly, Jen, are truly wild. We're talking about the world's first upside-down floating marina, an industrial city that is also meant to float on the ocean, and then the Line, which is, of course, a pair of mirrored towers running the length of 106 miles. But what we're talking about today is Sindala Island. This is the first asset that is due to open, and it's actually probably the most realistic of the bunch. It resembles something like the Maldives, if you will, and it's geared towards the ultra-luxury traveler. There's going to be resorts by the Four Seasons, by Marriott. There'll be a yacht club and a marina that can house more than 80 yachts. And why this is so important really is that there has been a lot of skepticism around NEOM. And so this is the first time that this exclusive group of VIPs will be able to get a glimpse at what is actually happening on the ground. So what we've been told is that there will be a soft launch opening in the days ahead. There'll be beach parties, performances, and people will get to get a taste of what NEOM may actually be like eventually.
Oh my gosh! Maybe, hopefully, you'll get to experience it from a reporting angle, of course, Christine, eventually. But talk to us about the significance of this, because you and the team have been covering NEOM for quite a while. What is the significance of this being the first project that it's opening?
Well, I think, as I mentioned, there has been a lot of skepticism around whether or not the Saudis can actually pull NEOM off. I mean, and as I was mentioning, it's a massive project, right? And this is a development that we know, based on our reporting, has come under a significant amount of challenge. Foreign investors, for example, have been reluctant to get involved and put their money down on the project. That means that the Saudis have been largely responsible for needing to fund all of the costs associated with NEOM, and that's happening at a time that the Saudis are seeing depressed oil prices weigh on their finances and really having to question how far they can stretch their petro wealth. On top of that, based on our reporting for this story, we've heard that some of the details that the Crown Prince wants to bring to life just aren't practical. I mean, elevators that can move vertically and horizontally, it's a challenge.
Christine, let's just finish off with the investment conference in Saudi. What can you tell us about what to expect?
Well, this is FII, which many unofficially call Davos in the desert. We'll see the biggest names in finance, banking, and investments descending on Riyadh next week, if they weren't already at this Sindala party over the weekend. But anyways, we'll see the meat of the action happening on Tuesday. The agenda says that we are due to hear from the likes of Larry Fink, David Solomon, Jane Fraser.
Right.
They are all due to take the stage and will be weighing in on AI, technology, of course, geopolitics,
right.
and then, of course, the belt tightening that we're seeing happening in Saudi.
Absolutely. Bloomberg's Christine Burke. We know you and the team will be there. Appreciate you joining us. That's Horizons Middle East and Africa this morning. I'm Jennifer Zabasaja. Stick with us for Daybreak Europe. This is Bloomberg.